Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Friday, December 6th, 2024. Today's episode, the unemployment numbers came out. This was the day. This was the day that could have potentially rocked markets and didn't. As we can see, the actual number for the employment numbers came out higher than the expected. Also, October's number got revised higher from, I believe it was 12,000 to 36,000. And the unemployment number was exactly as the market was already expecting, rising from 4.1% to 4.2%. Taking a look at the unemployment rate on the Fed website, starting this chart, current view from September 2022, we've been going higher. This is what triggered the SOM roll. This is typically when this is going up like this, when it's going whoop, that means we're in a recession. And so notably, though, we ticked higher, but we're still below July's reading of 4.3%. So the belief, the feeling of the market, obviously, at this point, is unemployment is stagnant. It's staying here for now at 4.2%. We're not even above the previous high. So to the market's perspective, it's flat, but it went up a little bit, meaning that the Fed will most definitely cut in this December meeting now, with now an 85% probability. And that can be seen here at the CME group Fed Watch tool. We now have an 85% chance of a cut and only a 15% chance of no cut. So Mr. Market at this point is massively overweight and is, going to get another sugar rush. And so he's perfectly happy to sit here near all-time highs, and the VIX here today breaking down to a new low, just sitting here comfortably. What could possibly go wrong? The majority of this show is going to be how the market is acting off of this report. And so before I go through the rest of the charts, the daily reminders remain the same. These are very important things. Watch Monday's show to hear me read through them. This is how I see the market on a macro view. One crystal ball rating changes today. Bear market, it's not imminent necessarily. I'm going to change that to coming. This employment report is not a shocker. This is like the Fed funds are going to lower rates. We might get that end of year Christmas rally. We might not. I'm not exactly sure, but I'm less confident about the bear market being imminent, but I do see it coming. And the rest of the crystal ball readings remain the same. Again, I'll read through these and explain them on every Monday's show. Going back into the charts, the S&P 500 closing in the S&P 500 0.25% higher on the day than yesterday. So comfy, not bearish, not yet. Maybe there's another black swan around the corner, and we'll see it when we see it. I mentioned on yesterday's show, preparing for the employment report, the 10-year, 2-year Treasury spread, like I say often, it was negative. When it goes negative, it means that the Fed, the Federal Reserve, is trying to slow down the economy. And typically, the longer they have to do that for, the worse the result is once it ends. And it did end. However, if it does re-invert, it could mean that the Fed is in a position where it is continuing to strangle the economy. So this is important here, that to me anyway, that the 10-year minus 2-year actually ticked higher today on Friday. My concern was that the market would interpret everything as honky-dory enough to the point where the market would start pricing in the Fed being tighter for longer. And it looks like we're in this Goldilocks zone where the Fed, people feel like it's going to be a soft landing right now. That's the long and the short of it. Not only do all of those things look peachy, at least on today's data on today's market action, only one day. This is important that this is just one day, but the 10-year break-even inflation rate actually went down today. The market, and it's only a tiny bit, right? 2.25 to 2.24. However, looking back, this is breaking to new lows. This is a significant chart pattern development suggesting that this can continue to the downside. So not only does the market believe that the employment situation isn't out of control, the market is perfectly fine and the Fed's going to help things move along anyway, and inflation is it ticked down today. That's a Goldilocks scenario. Not too hot, not too cold, just perfect. And yeah, with the employment number not being too hot and the unemployment number not going down too far, TLT also was able to go higher, along with the 10-year note yield going lower. This pattern on TLT is significant today, breaking up to the upside and sitting on the top of this megaphone pattern, suggesting there's bullishness in bonds. I wasn't sure if I wanted to share this, but the 10-year Treasury note itself breaking to a new low after kind of sitting for 1, 2, 3, 4, 5 days, not really being able to get below that, closing below that today. So this is headed down, and I'm not going to claim to be the greatest chartist in the world, but I am seeing a lot of lines right here. If we take, I think this is the high, yeah, you take the highs here and then you put them, connect it to this major low. That's where that line comes from. This line right here connects the two bottoms, and then this line right here, I can't figure out where that line came from, so I just deleted it. But you also have this other one here. These are all, this is important. I know it sounds like I'm a crazy person, where you get the typical detective with the pin board with all the, lines drawn all over it. No, but seriously, just take a look at this last line here, going back to the bottoms of 2021, connecting these two bottoms here, forming a parallel between the head and shoulders top of the TNX from the top of 21. This is a parallel to that line. You draw it down to this low here, and it also, the point is that all of three of these lines here all meet in the same place, suggesting that, psychologically, it looks to me like this wants to get down to here, to this point, before it fights and either goes back up. Maybe we remain sort of in this channel going up and down, up and down. Maybe this goes up and down, up and down, up and down still for a while. Or maybe this is, we finally get the pattern of the head and shoulders top to play out, which the end target is actually around 2.8%. Any which way about it, shorter term and longer term, it appears that TLT is finally proving itself to be a good place to be. And I mean that from, a charting standpoint. And remember, that's number 3 on my list. I always look at things first. Ben Graham's investment philosophy. What doesn't make sense in terms of discrepancies of valuations? And then macro, which is, it's sort of combined Ben Graham, that view. But then the macro views that you see on Monday's show, and then the technicals lining up to show, to give that extra support. So I'm very happy about Treasury bonds at this moment. Additionally to that, the MOVE index notably breaking lower today. Sorry, that was a weekly chart. I need the daily chart. As you know, it looked like we had broken to the upside out of this, and then we broke back into it, and now we're actually breaking like down out of this. So, when we were here and bond volatility was going up, it was just getting interesting. As bond volatility goes up, it can mean that the price of bonds can actually shoot up or shoot down. When bond volatility goes down, it generally means that, I believe anyway, that the bond prices can actually just float up. And that's what we have here. And so, I mean, Goldilocks. Everything's in Goldilocks mode. I also wanted to bring up the dollar only because it didn't do anything. It went sideways. Again, Goldilocks. Things aren't too hot, not too cool. And so people are confident enough in the dollar and not overly confident in the dollar. We're just going sideways. So it's a matter of time before we start figuring something else out as it stands right now as of today. There's some interesting divergences also going on regarding greed and fear. The high yield or junk bond spread is at historic tight levels, and we did not pop to the upside. This is signaling extreme greed in markets, extreme complacency actually. When we get, this is suggesting okay, it's Goldilocks and it's a little too quiet, kind of a thing. And while the VIX and many other markets are showing Goldilocks scenario, the fear and greed index actually moved to neutral today in the CNN business fear and greed index. Also, something I bring up rarely on this show, but it's a site that is in the folder of bookmarks that I open instantaneously every day. It opens a million tabs. This is interestingly in fear, only with 10% cash, but this is PY investing. It's a tool that can help limit drawdowns in the market using some formulas. It doesn't have great performance when things are just bullish, like oddly bullish for an odd amount of time. And we've been going through that period now for so long that it tells me that, this might even be one of the best strategies out there for defensive investors, perhaps. But it's in fear mode, and instead of being 100% in stocks, it's moving 10% into cash. Lastly, I wanted to bring up Bitcoin. Just so we're aware psychologically, Thursday's ginormous move to the upside and to the downside, forming a doji. This is most definitely a reversal bearish candle here. And in order for this to suggest otherwise, we need to see the bulls need to close above the wick of Thursday's candle. So we need a daily close above the $103,617 for a Bitcoin mark. We need to close above that in order for Bitcoin to continue bullish. Otherwise, this is the top in Bitcoin. The Bitcoin should actually roll to the downside from here. I'm sorry, I'm not sure you can see that. Let me zoom in at Thursday's candle, this wick here, this white wick. Can you see that? Okay, anyway, right here. We need to close above that. Daily close above that. Otherwise, this is bearish. This is a bearish chart. Bitcoin's going down. So now what? Now we see how the market, this was the initial reaction. Now, how does the market really react afterwards? What do the retailers do who aren't trading daily? How are they going to react to what's going on in the charts? What's going on, with this employment report that came out? Honestly, for the S&P 500, it's more likely, I think, to continue higher from here. At this point, I know there's one, Gareth Soloway, an amazing trader, said he's loading up on puts when the S&P 500 hits 6,100. That's his mark, and it's based on again a logarithmic chart on the S&P 500 going back to 1929 to the dot-com peak, connecting to right there 6,100. My take on it he's a way better chartist than me. But everything that I see with charts in my crystal ball says that I think that currently the S&P 500 should continue higher. But I'm not playing games in this. I'm not going to buy it just because I think it's going to go higher, because at the end of the day, I'm never going to put my capital at risk buying something that I perceive as being overly optimistic, overly greedy, and overly speculative. The price is just out of hand. But I suspect the S&P 500 will continue higher from here, but that's just me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time, Robschild.